Good morning and welcome to the B.F. Anderson Report for April the 25th. We're doing a special report today, mainly because of the volatility in the market. The market took a big hit yesterday, and I wanted to bring everybody up to date. Here's a graph just to kind of give you my thinking on things right now. This is the 10-year Treasury yield on the 10-year Treasury note. You can see here interest rates have really started to move upward and getting into an uptrend. In fact, you can see here that the moving averages are actually crossing the 50 over the 25. So we're seeing momentum to the upside on interest rates. Now, this is a problem for the market right now, and it's really a headwind for any kind of fixed income strategy. Clients ask me all the time, when you say to be defensive, which we are saying now, and be very cautious in this market because we are at an inflection point, and we have been raising cash, came in Monday and started raising cash on Monday. But the point being is that to me, to be defensive means cash, meaning money market fund. You don't want to get into bonds. You don't want to go into gold. You don't want to do that because you're getting into another market. You're just going from one uncertainty to another uncertainty. So with a risk-free money market fund, to me, is what would be a defensive move. Basically, stop buying, watch your stocks. Anything that's giving you trouble right now that you're uncomfortable with, you probably should be selling. Now, here's what I mean about the inflection point. And we're not out of the woods. Long term, everything looks fine. All of our long term indicators are fine. But, we're seeing here what we thought would be a double bottom, continues to be a double bottom, but could turn out to be a triple bottom with possibly a test of this area down here. So this could be what we call a failed breakdown. I'll show you a failed breakout in a minute in another graph. But there's three things that's going to happen here. One, we're going to break down, have a failed breakdown, and then turn up, because once this correction is over, there's going to be some tremendous opportunities out there, and you want to be in a position to take advantage of that. But as we look at the S&P 500 here, we see that it made a high in January, correction started. We've been, at best case scenario, we're moving sideways here. I mean, this is nothing more than a sideways move. So the question is this the beginning of a bear market? Well, this would be what I would look for. If we break the prior low, which is 25.30, and we continue to in a downtrend below there, that could be the makings of a bear market. But if we can hold in here and then rally, that would be nothing more than a correction. Now, if we look at the long-term just some long-term indicator, we're looking at a 50-day moving average versus a 200-day moving average, and this is as of yesterday. And basically, you can see here that the slope of the 200-day moving average continues to stay very positive. And if you go back to the end of the bear market in 2016, going into the election, you can see the crossovers. It looks like spaghetti in here, just all mixed and crazy. Well, we're not seeing that right now. Now, if you want to see a bear market, this is what a bear market looks like. I went back to 2007, and you can see we have a death cross and the moving average, which is the 50-day versus 200. You can see the 200-day is in a steady decline. The 50-day is below the 200, steady decline. This is the bear market of 08. So that's what it looks like. And we don't see, right now, we're not seeing anything like that. So, you don't want to get too disgruntled here, because it does look like, it looks like 1991 when the market went through a very difficult period at the beginning of the year, but ended the year up 26%. Now, again, if we go back and look at the concept, the longer the base, the greater the race. The market has been doing really poorly. This is the New York Stock Exchange Composite Index, which is every stock on the New York Stock Exchange, moving sideways. Okay, here's your failed breakout. Now, I mentioned to you earlier we had a failed breakdown here. So in other words, what happens at the end of these bear markets or at the end of these corrections is you'll get a dramatic drop, and then it's over, and then you have the opportunity. So what we're seeing here now is a breakout from the bear market in 2016 after the election. Then we get the strong rally going into January. We've pulled back. So, a lot of people are frustrated because you go through an extensive period like this, especially those 3 years in there, 14, 15, and 16. You just get really frustrating, very, very frustrating. Well, in other words, we have broken out of this and we are holding the breakout. So long term, everything looks good. Now, I do want to point out something that is another facet to this thing that I think is important to understand. If we were in a situation where the economy was deteriorating, you would not see the small cap stocks starting to outperform. So what I've got here is a ratio. This is a ratio of the small cap index, the S&P 600, versus consumer staple stocks. I'm talking toothpaste, toilet paper, tobacco, that kind of stuff. So in other words, if we were in poor economic periods, the toothpaste stocks would be leading the way. Well, it's exactly the opposite. The small cap stocks, which don't do well if the economy is deteriorating, they're beating the pants off of the consumer staple stocks. So you need to be aware of this. Let me give you an example of what I'm talking about. Here's Pepsi-Cola. Look at this. I mean, this thing is really, really tanking. So why is this? Well, it could be that money is just moving around. It could be a variety of reasons. But like even here's Procter & Gamble. You can see the same pattern. So if the economy was deteriorating, I really think stocks like Procter & Gamble would be outperforming and doing well. But interest rates are rising, and interest rates are rising because the economy is doing well. There's demand for capital. Now here's Philip Morris, which is tobacco. Now this is dropping also for another interesting reason. There's a new technology out there that's really disrupting tobacco. It's called vaping. And a lot of the millennials and the young kids are getting off cigarettes and they're going to vaping. Cigarettes are so cotton picking expensive now, I don't see how these kids can afford them. So the point is that these guys that are selling products that kill our children, the stocks are getting whacked because there's a new technology out there called vaping that is replacing cigarettes. So in conclusion, what I'm saying is this: long term, everything looks fine. It's just that we are in a situation now where the institutions are selling, not buying, and I would say this is a good time to be cautious and just maintain your portfolio by anything that's giving you trouble. You need to tighten that stop loss. Let me know if you have any questions. Thank you.